Hello everyone and welcome back to Sumsub for Expert. My name is Sivakumar. I'm joining you here for the very first time as a new host on this channel. I am APAC Legal Director at Sumsub and I lead our regulatory and compliance strategy across Asia Pacific. That means I work closely with clients, regulators and partners to make sure our AML and KYC solutions meet and ideally anticipate evolving standards across the region. For my first session here, I'm tackling a topic that couldn't be more relevant in 2025, cross-border payments in APAC. Why this topic? Because the region is exploding with innovation while also facing fast rising compliance demands. And navigating that balance is critical for every business in this space. To set the stage, consider that the global cross-border payment market was valued at $194 trillion in 2024 and is projected to reach $250+ trillion by 2027, with APAC leading the way, about 35% of global volumes. In other words, more money is zipping between APAC countries than ever before. This growth is fueled by fintech innovation and rising digital commerce, but it also brings new risks from money laundering to fraud that regulators are keenly watching. In 2025, authorities in financial hubs like Singapore and Hong Kong are tightening AML and KYC rules and leveraging technology like AI monitoring to combat financial crime. So, balancing fast-paced payment innovation with robust compliance is absolutely critical these days. Today, I will walk you through key trends in APAC cross-border payments, compliance challenges, real-world examples, and how businesses can innovate safely in this space. With that context in place, let's look at what's actually happening on the ground across APAC. Let's start with one of the most exciting shifts: real-time payment linkages. Across Southeast Asia, countries are literally connecting their domestic instant payment system to work closely across borders. Singapore's PayNow and Thailand's PromptPay were connected in 2021, allowing instant mobile number transfers between two countries. Transfers that once took days now complete in minutes via this linkage, with up to 1,000 Singapore dollar transferable daily just by using a phone number. The result? Lower fees. Instead of hefty remittance costs that used to run as high as 10% of the amount sent. Following Thailand and Singapore's lead, Singapore-Malaysia real-time payment went live. PayNow, Do It Now linkage in 2022, and Singapore's PayNow was also linked to India's UPI in 2023. Indonesia, Malaysia, Thailand, Singapore, and the Philippines have a vision to connect all their fast payment system via a common platform called Nexus 9, avoiding the web of one-to-one integration. In short, APAC governments are actively stitching together national payment system to enable seamless instant cross-border payments, especially within ASEAN. This makes cross-border transfer feel more like local ones, which is a game changer for businesses and individuals. As these networks scale up, expectations are shifting. It's no longer just about faster than before. The demand is for instant, low cost, and even alternative payment settlement rails. Let's dive into that next. Now, let's talk about the pressure that's reshaping the industry. The demand for faster, cheaper settlements. Merchants, payment service providers, and yes, even crypto firms are saying the same thing. Traditional correspondent banking is too slow and too expensive. This demand is driving adoption of blockchain and stablecoin as alternative rails. In fact, 2025 is being called the year of stablecoins for cross-border payments. Stablecoin transactions volumes have exploded, reaching $710 billion per month in early 2025, up from $521 billion a year earlier. As companies experiment with using USDC to move values cheaply across border. And this isn't just a hype. We are seeing real business use cases. E-commerce marketplaces paying overseas vendors in stablecoins, freelance marketplaces paying contractors, etc. Growing number of payment providers, even giants like WorldPay, have added stablecoin payout feature. driven by merchant demand for quick settlements. Essentially, everyone from small import-export businesses to cross-border exchanges wants cross-border payments that clear in seconds with minimal fees. And they are exploring new tech to get there. This is pushing banks and fintechs in APAC to innovate or risk losing customers to more agile platforms. And it's not only private companies driving this push. Central banks across APAC are also experimenting with new infrastructure. That's where central bank digital currency, CBDCs, and collaborative projects like mBridge come in. Multiple countries have launched CBDCs pilot aimed at improving cross-border payments efficiency. A prime example is Project mBridge, a collaboration between Hong Kong, Thailand, China, UAE, and others under BICE. In its 2022 pilot, mBridge allowed 20 banks across 4 jurisdictions to complete over 160 real cross-border forex transactions worth 171 million Hong Kong dollar using multiple CBDCs on a single shared ledger. The goal is to show that a multiple CBDC network can make cross-border settlement instant, cheap, and secure, bypassing the old, slow correspondent banking chains. In sum, APAC is witnessing a true payment revolution. Domestic payments going regional, crypto and fintech alternatives rising, and central banks reimagining the plumbing. But with great innovation also comes great responsibility, especially on the compliance front. Let's talk about those challenges. Here is the first, and arguably the biggest compliance challenge in APAC: fragmented regulations. APAC, as you guys know, is not a single regulatory regime. It's a patchwork of different laws in each country, and this fragmentation is challenge number one for cross-border fintechs. Licensing criteria, permitted activities, customer due diligences, data localization laws, they all vary by market. For example, Indonesia and Vietnam require onshore processing and local data storage for transactions. Thailand and Malaysia impose specific rules on how funds can be repatriated and invoiced across borders. India has a complex requirement like GST and TDS taxes on cross-border service and strict forex reporting for payments. This means a Singapore-based payment startup servicing customers in, say, Indonesia might need to comply with both MAS regulation and Bank Indonesia's rules, which can conflict or at least add extra layer. As a practical example, a Singapore PSP processing e-commerce payment for Indonesian merchant would need a major payment institution license under Singapore's PSP and might run into Indonesia's ban on offshore payment processor unless they partner locally. Each country's AML rules also differ. For example, threshold for verifying source of funds, list of high-risk countries, etc. So a compliance program that works in Hong Kong might be deemed insufficient in Australia, England, or in Japan. In short, one size does not fit all. Companies must navigate a maze of country-specific laws, which is resource-intensive and prone to errors. As reports put it, what's considered through due diligence in one jurisdiction might raise alarm in another. This fragmented regime is exactly what criminals exploit: gaps between rules. It also leads to complexity like data privacy versus AML conflicts. For example, strict privacy laws like GDPR in Europe or local banking secrecy in APAC can hinder sharing customer data for AML across borders. All of this makes compliance in high-stakes puzzle for cross-border payment providers. And just when you think you are mastered traditional compliance, along comes another fast-moving challenge: crypto regulations and travel rules. Let's get into that. So another major challenge is keeping up with new AML rules for digital assets and cross-border crypto transactions, especially FATF travel rule. The travel rule requires that when virtual asset service providers send crypto on behalf of a customer, they must send identifying information about the originator and beneficiary to the next institution, similar to rules for bank wires. Different APAC countries have rolled this out on different timelines. which is tough for exchanges operating region-wide. Singapore and South Korea were early adopters. Singapore implemented it in 2020, while South Korea implemented it in 2022, while Japan and Hong Kong only implemented it in mid-2023. This staggered implementation causes what we call a sunrise issue. Some exchanges must comply and share data, but if counterparty exchange in another country isn't subject to the same rule, yet the system breaks. It hinders connectivity, compliance, and transparency for crypto transactions across borders. Beyond the travel rule, crypto businesses face varied AML and CFT expectations. Hong Kong's new VASP license regime mandates robust KYC, transaction monitoring, and sanction screening on crypto transactions, in line with FATF standards. Japan updated its laws to require exchange of information for crypto transfers above a threshold. Many unlicensed or smaller crypto firms struggle with implementing the necessary tech protocols to share travel rule data or to screen unhosted wallets. This is where solutions like Sumsub and others come in, offering API-based travel rule, compliance tools, and unhosted wallet verification method. But adoption is still ramping up. Net-net, the regulatory goalposts for crypto compliance are moving fast, and any company doing cross-border crypto payment must hit a constantly evolving target. Non-compliance isn't an option now. Regulators in APAC have shown they will impose fine or even license revocation if exchanges or fintechs slack on these rules. And crypto isn't the only headache. Businesses also have to juggle data localization rules, endless reporting requirements, and rapid-fire regulatory updates. Let's unpack those next. First, there is a data localization. Countries like India, Indonesia, and China require payment data and KYC information to be stored domestically. That means you can't just centralize everything in one global system. You may need separate infrastructure in each market or use local cloud providers. Needless to say, that adds complexity and, of course, the cost. Extensive reporting and record keeping are another burden when you operate in multiple countries. You might have to file transaction reports to each regulator in their preferred format and retain records for different duration. For example, 5 countries in one country versus 7 countries in another. For instance, a simple cross-border transaction could trigger reporting obligation to MAS in Singapore, while AUSTRAC in Australia, and so on, with each of its own form. This administrative load is immense. Finally, keeping up with regulatory changes is a constant struggle. Rules are updated frequently across APAC. If FATF updates guidance, say a new risk countries or virtual assets, each country may implement it on a different timeline. Compliance needs to monitor multiple jurisdictions' challenges simultaneously, a real challenge for startups with lean teams. Missing an update in one country could mean inadvertent breach. All these factors make compliance in cross-border payments a moving target. Now, to ground this in reality, let's walk through a couple of practical examples that illustrate how these challenges manifest for businesses. Imagine a Singapore-based payment service provider has a client, merchants in Indonesia. It processes online payments for Indonesian e-commerce sellers, then remits funds from Singapore to Indonesia. This startup faces a compliance puzzle on multiple fronts. First, in Singapore, the PSP likely needs a license under the Payment Service Act from MAS, which brings obligations like AML screening of customer, transaction monitoring, etc. for all its activities. Now, because it's dealing with Indonesian merchants and consumer payments, Indonesian regulations enters the mix. Indonesia has a strict rules distinguishing onshore and offshore payment processing. Essentially, Indonesia wants domestic transactions processed by locally licensed entities. Our Singapore PSP could be viewed by Indonesian authorities as doing offshore acquiring, which might require partnering with a local Indonesian bank or obtaining explicit permission from the regulators. There is also data localization. Indonesia's law may require that Indonesian customer data or transaction records be stored in Indonesia. So the PSP must set up a proper data storage in country or face compliance risk. Additionally, the PSC must comply with Indonesia's AML rules for any rupiah transactions. For instance, verifying source of the funds for large payment and reporting suspicious transactions to Indonesian FIU, on top of reporting to Singapore's STRO under the MAS rules. As you can see, the company ends up needing a dual compliance program. Practically, they might maintain two onboarding funnels, two sets of KYC standards, one to satisfy MAS requirement, another to satisfy Bank Indonesia's requirement. They also have to train staff on both jurisdiction rules and perhaps hire local compliance officers in each country. This example highlights how cross-border business must comply with both MAS and Bank Indonesia's regimes in parallel. Not easy and not at all cheap. Any misstep could result in penalties or losing the ability to operate in that market. It's a tightrope walk that many regional fintechs are navigating these days, balancing innovations and compliance. So with all these challenges, the natural question is, how do you innovate in payments without tripping up on compliance? Here are three approaches that really makes the difference. First one, adopt a risk-based approach. Rather than one-size-fits-all compliance policy, companies should calibrate controls based on risk. Regulators in APAC actually expect this. Both MAS, HKMA, and other regulators emphasize a risk-based approach where higher risk activities or customers get enhanced scrutiny and lower risk ones have a simplified process. In practice, this means performing solid risk assessment by customer type, corridor, transaction size, etc., and allocating your resources accordingly. For example, a fintech could set stringent KYC for users sending funds to higher risk jurisdiction or business client versus retail clients. A risk-based monitoring rule might flag, say, a first-time transfer from a customer to a new country over $5,000 for a review, whereas a repetitive $50 transfer might bypass manual review. The idea is to allow innovation, customer convenience for a low-risk scenario while focusing controls where they matter the most. Regulators appreciate when firms can demonstrate this nuanced approach. It shows you are not just doing tick box compliance, but truly managing risk. Second, leverage flexible RegTech solutions. Technology is your friend here, especially solutions that are configurable to different regulations and can automate compliance codes. We are in an era where RegTech tools can drastically reduce false positives and manual efforts by using AI and advanced analytics. For instance, AI-driven transaction monitoring system can learn more patterns and flag truly abnormal transactions, cutting false positive alert by up to 70% and improving detection rates. This means your compliance team spends less time on real issues, not chasing ghosts. Another example, an automated sanction screening tool that updates global watch lists in real time ensures you don't miss a newly sanctioned name. And it can screen thousands of payments a second without fatigue, something impossible manually. Sumsub's platform offers a single dashboard where you can customize rules, integrate various data sources. For KYC, Sumsub and similar providers lets you configure verification workflows per country. For example, you can set the system to require national ID for a user from Singapore, but a passport plus selfie for a user from Malaysia, reflecting what regulations expect. This configurability is key when you operate in multiple jurisdictions. Additionally, Sumsub's API-based verification means you can plug identity check, document verification directly into your app's onboarding flow, ensuring smooth user experience while meeting compliance. On the crypto side, Sumsub integrates with blockchain analytics partners. This kind of real-time wallet risk scoring allows fintechs and exchanges to automatically block high-risk crypto transactions before they happen. Importantly, many RegTech solutions today come with built-in rules library that reflect best practices, or even specific regulatory requirements. And you can tweak those rules or create new ones to match your risk appetite. For a compliance officer, having a no-code or low-code rule builder is a godsend. You can respond to a new regulation, say lowering a threshold or adding a keyword to flag, by updating a rule in the system rather than overhauling your entire process. The bottom line, automation flexibility is your compliance tooling. Not only keep you ahead of criminals, but also make it feasible to expand to new markets without starting from scratch. In fact, studies have shown RegTech solutions can cut compliance costs by as much as 80% while increasing accuracy, a win-win for innovation and compliance. Use these tools to turn compliance into a competitive advantage. And third, most importantly, engage regulators and use sandboxes. Innovation tends to move faster than regulation, especially in fintech. A smart way to balance the two is to actively engage regulators early when you are rolling out something novel and new. Many APAC jurisdictions encourage this program through regulatory sandbox programs or innovation offices. For example, Singapore's MAS has a fintech regulatory sandbox where a company can test a new cross-border payment service with regulatory relief for a period under MAS guidance. Likewise, Hong Kong's HKME has a AML RegTech lab and sandbox initiative to pilot new compliance tech in collaboration with banks. By participating in these sandboxes or consultation, you get to shape the rules or at least anticipate them rather than being caught off guard. It's also a signal to the regulator that you take compliance seriously even as you innovate. In short, balancing innovation with compliance in APAC boils down to being proactive. Use the best tools and practices to keep compliance by design and keep the dialogue open with regulators. So we have covered a lot today, from instant payment linkages to crypto rails, from central bank experiments to the tough compliance challenges businesses face. So let's wrap this up with some practical takeaways for business operating across in APAC, depending on who you are. For traditional fintech payment companies, make compliance an enabler, not an afterthought. This means building a regional compliance strategy from day one. If you are expanding to multiple APAC countries, invest early in expertise for each key market or choose a compliance partner that covers those bases. Ensure your systems are API ready and modular, so you can plug in country-specific checks or new regulatory requirements without overhauling everything. Don't shy away from engaging with local regulators. If you hit a confusing requirement, and you will given the fragmentation, approach the regulators or join local industry groups to seek clarity. Oftentimes, they appreciate the initiative and may provide informal guidance. Another tip, localize your approach to AML. For example, understand cultural nuances of fraud in each country. Scams in one country might have different typologies than another, and tailor your fraud rules accordingly. It's a lot, but the payoff for getting it right is huge. You avoid costly enforcement, you gain a reputation as a trustworthy operator, and ultimately, you will spend less time firefighting compliance issues and more time innovating. Remember, in payment, trust is everything, and in APAC's environment, trust is earned by demonstrating compliance and security. So invest in that compliance infrastructure as a core part of your growth plan, not as a checklist item. Second, for crypto and digital asset firms, embrace the regulation. It's here to stay, and being proactive will set you apart. If you opt a crypto exchange, embed AML controls deeply into your platform. This means integrating travel rule solutions now. Finally, educate your user base as well. A lot of crypto users are new to concepts like travel rule, so transparency helps. If you explain that providing certain info or waiting for a compliance check is about protecting them and the ecosystem, users are more likely to cooperate. In summary, don't play cat and mouse with regulators. In APAC especially, regulators have shown they will support innovation only if you play by the rules. On a final note for everyone, cross-border payments in APAC presents massive opportunities, whether it is reaching new customers, enabling the unbanked to access global services, or building entirely new financial platforms. By balancing innovation with solid compliance, using a risk-based approach, the latest RegTech, and a cooperative stance with regulators, you can seize this opportunity safely. Thanks for joining me for my first session here in Sumsub for Expert. I'm excited to continue this journey with you, and I look forward to many more discussions ahead. And if you enjoyed this episode, don't forget to like, subscribe, and drop your thoughts in the comments. I'll be keeping an eye out for your questions in future videos. Thank you.